I wrote a book called Best in Class about 3.5 years ago, I guess, and was really talking about asset management when a lot of people weren't. And that helped really build my reputation. So people respected what I was doing.
Yo, what is up, everybody? This is the Go Big Live Real Estate Investors Podcast. I'm your host, Matt Drouin. The show to listen to or to watch if you are a smaller investor that's buying single family, duplexes, all that good stuff, and banging your head against the wall, sick of it paying you chump change, want to bust through the ceiling and go up into doing larger commercial deals. I have a treat for you today. I'm psyched out of my mind to have Mr. Gary Lipsky, who is founder and CEO of Break of Day Capital. I'm really excited to actually dive into Gary's background and bio because he had a long standing in the education industry, wondering why he got into real estate. But he is an absolute beast, has acquired over 3,200 apartment units, valued in terms of transactions over $300 million. And I am really excited to have him on the show and hear about his story and best practice and how he did his first bigger deal at the time, and we learned from it. Thank you for coming on the show, Gary. I appreciate it.
Yeah, thanks for having me, Matt.
All right, so first question is a doozy. You were born, now you're here. What happened in between?
Yeah, I grew up in North Jersey, and I had the entrepreneurial bug in me from a very young age. We had like an auto detail business growing up, and did a bunch of different adventures over my lifetime. So very hands-on. I felt like I got bored if I never really worked for anyone else because the very few times I did, I would get really bored. Like I need to be hands-on. I need to be doing it. Certainly I'm going to be making a lot of mistakes because I'm not learning from someone else, but I much prefer that way to take my punches on the chin and learn from there. I feel like that's much more exciting for me. So um, I co-produced 3 low-budget films in my 20s. I started an after-school outdoor ed and leadership development company as well. And I grew that to, we were working with 9,000 students daily throughout Southern California. And I loved what we were doing. But I was ready for my next challenge. I had been investing in real estate for a while, and I was ready for my next venture. I've been doing it for a while, and that's when I got to real estate full time. I had a little bit of money in my pocket, and I learned everything I could, started investing passively in some other people's deals, and then started doing my own deals.
So, Gary, I mean, where did this entrepreneurial spirit come from? Was it like innate, or was it something that you had factors in your childhood that, or things that happened that made you kind of go in that direction?
My dad was a CPA at the time. My grandfather was an accountant and lawyer. But they would never talk to me about investing or being an entrepreneur. It was just like innate that I don't know. I took some entrepreneurial classes, and because I was a middle child, you tend to be more independent. Like I don't know what was in me, but that was the path I went. And when I went to college, I went to Boston University. I majored in business and more along those entrepreneurial path. And it just was always intriguing to me somehow, some way, and I was cleaning out my parents' house not too long ago. And, I still had some of those like entrepreneurial books from like when I was a kid, like Dave's Way from the Wendy's. And there was a few other like entrepreneurial books that were still there on like the bookshelf.
So, I mean, I'm a little bit curious when I dig into, you had a pretty extensive background in the education industry as an entrepreneur. Like, why real estate? It just seems so random to me. My wife is a professional educator, has been for the past 14 years. She still just doesn't get what I do, like why I do what I do. So tell us about that.
So a number of things. I like scale, and so we had grown that business to 9,000. We were able to do that because we were very creative, finding solutions for school districts, charter schools, stuff like that. outside of the box, and that's how I looked at it, real estate. I love the creative, the business side of things. And I had reached a ceiling on how much I could make because we were a for profit in a nonprofit world. I wasn't challenged anymore. I had built up a really good team. And so I had done well on some real estate that I had purchased, studying markets, doing some value add in the house that we owned. Little did I know that that was going to be my future, but that was the makings of it. And then buying another house and turning the other one into a rental. And so I saw, um, I guess, the beauty of investing in real estate, and I wanted to 10x that. I wanted to create that financial freedom for my family, and I knew that was the right path, and I was ready for that next venture, and so that's why I dove. So really, it's just my entrepreneur. Even though I was in the educational space, I still thought of myself as an entrepreneur, and even in real estate as an entrepreneur, because trying to stay ahead of cycles and where things are going, and just thinking of it that way versus um, you know being a diehard, like being in real estate for forever, and having my parents or someone in my family teach me about it. It was just me as an entrepreneur trying to figure out, how can I do it? How can I maximize my time, my investments, and pool my resources to get the best possible outcome for my investors and me?
Mm-hmm. Now you're investing passively, and then there's a transition period of maybe you bought some smaller deals on your own. Let's talk about the transition to commercial multifamily, because your focus is in, and we're going to talk about focus today because you talk about that a lot on some of the other podcasts you've been on. Phoenix and Tucson value add deals, most namely. Like, what was that like transition? Let's talk about like that first bigger deal that you did, or what was big for you at the time, and kind of pull threads at that and dissect that in excruciating detail.
Yeah, and that transition was very important because I thought I had to do like a 4 unit and a 6 unit and an 8 unit and kind of build up my resume over multiple years before I went to investors. And I went to a seminar, I guess you would call it, and they talked about pooling resources and working with others. So our first deal was a $1.65 million deal that we bought. Should have bought the whole block. We raised 1 million. But the next deal, the big deal that you're talking about, we had come in second, third, fourth on so many deals in Phoenix, and although it was incredibly frustrating, we were doing the reps, and so we were gaining experience on what was a good deal, what was a bad deal, watching it when the next person took over and bought that property, what happened with it. So the next deal that we did was that just over 15 million. I think it was like 15.3 million. So to go from a 1.65 to a little over 15 on our second deal, yeah, that was going big. Um, so it kind of materialized. The broker sent it to a friend who had a full time job, and he didn't have time, so he sent it to my business partner at the time, and he's like, he underwrote it immediately. He's like, "We're leaving tomorrow, driving out to Phoenix to check this out immediately before it kind of went to market." So I think we left, I don't know, 5 a.m. Drove out there. It was like 5 hours to do it. We walked the property, and we felt really good about it. Um, and so we had some people that we wanted to work with, and one of the guys was just kind of hemming and hawing and just over analyzing the deal. And finally, we're like, "Dude, are you in or you're out?" Because we want to take down this deal. And finally, he was out. We've had to find new partners, and I'll tell you, we had so many people say no to us to partner up, um, but we were very confident in the deal. Not overconfident, but we felt like we really knew the market, and we felt like it was a good deal. And ultimately, we found some partners to raise some capital to, sign on the loan to participate in the asset management calls and whatnot. And they thought we really had a good deal, so it made us feel good. but of course, nothing's a smooth ride. And so this is in the summer of 2019. Excuse me. And I think at the time, Fannie and Freddie started hitting their max on what they can loan for the year. So all of a sudden, rates started skyrocketing, and we're like, "What the? We can't take down this deal at this point." Now their interest rates have changed drastically. We're going to have a webinar for investors, so we pressed a pause on that and said, "Give us a few weeks. Let's see what shakes out." And we just kind of, let the smoke clear, and things, I think they raised their limits on what they could loan. The rates started dropping again, and so now we had a viable product to get investors. But I mean, obviously, it was a huge jump and raise from the first deal, 1 million. This deal we had to raise 5.7. So uh, we really had to step that up. And honestly, I mean, I sucked at raising in the beginning, and I sucked less on this deal. But that was something I really had to work on and get comfortable with, which took some time. Um, but ultimately, we were able to close the deal on time. I think it was November 2019. Um, and of course, COVID hit a few months later after that. Um, but that deal ended up being a home run. I mean, we're in the right market at the right time. We ended up doubling investors' money within 2 years, even after a prepayment penalty of $2 million because we had long-term debt and shouldered short-term. Uh, but it all started with finding the right deal and having our conviction to get the deal done, and finding through. We changed property management throughout. We had a lot of um, delinquency and a lot of unknown in COVID. I mean, it wasn't smooth sailing. Even through the sale wasn't smooth sailing, but persistence pays off in any entrepreneurial activity you take on.
Let's talk about the capital stack here. So we had a 15 million acquisition, $10 million worth of, it was a $10 million worth of agency debt, and then $5 million worth of equity. Is that what made up the capital stack?
Yeah, probably the loan was like another $1 million because of acquisition fee, closing fees, stuff like that. But basically, that.
Absolutely. So let's back up a little bit. So I want to talk about the methodology of deal flow and how you've perfected it and had it work in your favor and what you did on this deal, because a lot of people out there is like, I just need to take the first big deal down and then, establish a case study for myself, prove to myself that I can do it, and then kind of refine operations and acquisition strategy from there. But I guess what was your methodology and order of operations to even get in front of this deal? Like, what were you doing out there?
Yeah, obviously, even though it was a very small deal, our first deal, that 1.65 million, it was an ugly looking property. But again, I don't care how ugly it is. It's all about the numbers. But that gave us a little bit of momentum, and then constantly looking at properties, developing broker relationships. It wasn't all like computer and phone. We would go to Phoenix on a regular basis, walk the properties, walk the comps, give feedback, bid on properties. So there wasn't an extreme amount of trust in us because we hadn't taken down a bigger deal, but they knew we were hungry, and they knew what we were talking about because we were asking the right questions. We would bring a property management company, to get comfortable with the renovation budget and stuff like that. So we were doing our work, doing the reps to get us in position to take down that deal.
Now, on the raise, so it sounds like you brought in a co-general partner to help with the capital raise on this $5 million
Yeah,
deal. Okay.
we had I think there was one, two, three, four, five or six. Yeah, six guys, I think. Yeah.
Where did those relationships come from?
And meetups, and one friend led to another. I mean, like I said, we called many people within the networks, and it's just finding the right people that believed in your deal. And then one guy brought in another guy, and so it there's always people that are either tied up with one deal or another. So it's really important to have that network of people, whether you're raising capital, or you have an issue that pops up and you want to go through your network and say, "Hey, I've never dealt with this before. Have you dealt with it? Do you know the answer or know someone that will?" And that's paid off tremendously for me, building that network.
Yeah, so going to meetups, and I've met people that are in the capital raising space of multifamily and at conferences, many different conferences and that sort of thing. I guess like, what's your systems now for cultivating in relationships with investors and also co-GPs as well, in terms of actionable types of tactical stuff that people can do out there?
Well, cultivating relationships with investors, you've got to send out your newsletter on a consistent basis and add value. That's number one. I think that's probably one of the most important things that you can do. Social media helps, and people are watching you, even if they don't comment or like. But that consistency on that newsletter and providing quality education, I think, is the most important, because you might have someone that might not come in on your first deal or your fifth deal or your seventh deal. You just never know when someone's going to come in. But if you're putting out good quality information consistently, eventually they will see what you're doing if you're doing good work and come aboard. Um, being very active, going to conferences, going to meetups, um, not overselling. So people will, if you have a good vibe and you're being honest and just talking about what you're doing and not like really selling, just sharing, that goes a long way in just building your network, because it just grows and grows over time. It doesn't happen magically quickly, and the more exits you do, the it really starts to snowball. But it does take time to grow that list. And like I said, I was horrible at it at the beginning. I just wasn't comfortable talking about myself and what we were doing. But pushing myself outside my comfort zone, I just got a little bit better and a little bit better over time. Um, as far as developing co-GPs, again, just people, I wrote a book called Best in Class about 3.5 years ago, I guess, and was really talking about asset management when a lot of people weren't. And that helped really build my reputation. So people respected what I was doing. And so that really helped develop relationships with co-GPs. And again, just the conversations that we were having, that I wasn't over promising, and I was transparent and diligent and persistent. And people talk. And so, one co-GP begets another co-GP, begets another co-GP. And just being really mindful of the people that I attracted to, that I wanted the same person on my team that didn't overpromise, because I want investors. That's why we don't have problems with investors, because we're not overpromising. We want to make sure they understand the deal. If it's their last bit of money, they shouldn't invest with us. And so having those real conversations with people is very important.
Yeah, I mean, one of the things is that I put a piece of like short form content out there that I'll be posting a couple of weeks, but study the frauds out there. Is really, you'll find the breadcrumbs. Like, how did Bernie Madoff make off with the billions of dollars worth of investor capital? It was by being omnipresent, not overpromising. He was not one of those investment managers that was, hey, I can, promise you a 20% IRR. He was like, hey, I have a track record of delivering 10% consistently, and also not overselling either. You had to know somebody who knew Bernie Madoff in order to do that. So he wasn't out there that like trying to, put the hard sell on anybody. And not to say that you should, orchestrate some Ponzi scheme, but I think that by watching those people and studying like what, success leaves clues, right? And I think you like hit the nail on the head with everything you just said. I do want to get a little bit techie, because I do have a newsletter myself. And by the way, I forgot to mention that you are an author. So congratulations on that. Writing a book is not easy. But on email newsletters, right? how do you, and I put value out there, right? Like, I pour my guts out there in terms of like, the value that I give. It's not, any type of like puff pieces or anything like that. Like, how do you positively affect a better open rate on the newsletters you do send out?
I think a good hook. And we've gotten better. Certainly, I think some of our hooks in the beginning weren't good, and not, and I mean, we're not like a bombastic type of, like putting hooks out there, like, clickbait stuff. But it starts with that. It's not having too much information, but really some key things. We have a pretty good click rate. So I guess people are like our content, but it's not having it like so wordy too. You've got to be. I feel like you've got a few paragraphs and then move on to the next topic and not be so wordy too. So because time is money and people their attention span is relatively short these days. So you got to make it easy to read as well.
Yeah, that old thing, too long, don't read, TLDR. I didn't know what that meant until I had someone on my show tell me about that and what they use with newsletters. Yeah, and also like a slick trick out there for people that are thinking about doing a newsletter. Like, yeah, don't do, hooky, clickbait subjects like, quick question or question on the actual subject line. So there's a fine balance between not being too long, but also, really thinking and putting a lot of time into the actual subject line, and also making sure your newsletter is mobile friendly as well. So let's move forward to this deal. All right, we're probably glossing over a lot of details, and fill in some battle scars you may have earned during the process from where we're talking about now to closing. But we got to the closing table. It's day one. What did you like? What happened from there, and what did you learn from it?
Yeah, so we had a property manager that kept saying she was doing things, and we just didn't feel like she was, and so we would show up unannounced at times, and we're like, well, you promised, you said this was done and that was done, and so ultimately we had to get rid of her. We had a regional manager that was very nice, accommodating, and I think we stayed too long with her as well because she wasn't getting the results we needed. But it's very important that you set up those expectations from the very beginning, and if they're not hitting it, then you review it again. And she just wasn't, and so we probably stayed, like I said, too long with her because she was nice, we were being too nice, and so ultimately we got someone else that really started having a much better effect on our property. Now, COVID hit, we had um, certainly a lot of people coming on our property that didn't belong there and were causing havoc. Um, that we had to fight through. We had to fight through some occupancy issues. Nothing like major. I mean, I would say closer to maybe like 85% than below that. But making sure people filled out their Arizona like COVID money they can pay it, and a lot of people weren't doing that, which was very frustrating. But luckily, yeah, it's insane. Like here, you're getting free money for someone to pay your rent. But that's one of the reasons why I like Arizona is if you weren't doing that, ultimately we can get you out. Whereas where I live in California, you don't have to be paying rent. You don't have to be doing anything for multiple years and not and be fine. You know.
Mm-hmm. Yeah, no, we fought through the same thing in COVID, and I was laughing because we were like, hey, just fill out this form and we can get your rent paid. And people just, this wasn't everybody, but it was enough to be annoying as hell. it's like, and they're like, you can't evict us. We were in New York State, right? So they had an eviction moratorium and all that good stuff. And I was like, we don't have to pay rent. You can't evict us. And I was like, yeah, but the chickens are going to come home to roost at some point in time. And don't you want to be like, have a roof over your head? And that's, that's what happened. Like we sustained, a lot of vacancy and collection loss. Nothing that was fatal, but yeah, no, I definitely, I definitely resonate with that story and what we went through as well. So you had some of these occupancy issues. Like, what would you say, like the winning strategy was to really turning this property around? And then also what was the original exit strategy in terms of the business plan, and how did that reconcile with what ended up happening in reality, and what was the outcome to your investors on the exit?
Yeah. One, persistence, staying on top of the deal, visiting it on a regular basis is so important. We were doing the unit turns. I don't think we had paint in our initially on our business plan. But ultimately we decided to paint the property. We had the budget because we did put in extra for capex. This was a 128 unit, and so the bigger properties too, you can have more money set aside on capex, which gives you some margin for error. So that really helped beautify the property. We rebranded it from the beginning. It was La Casa, and so we made it East 3434. So more open to all the demographics versus just a solely targeted towards Spanish residents. But we did execute the bulk of our business plan. We were able to raise rents. We got that COVID boost, and that really helped us. And we saw the market just really take off, and we just took advantage of it. We thought, here we have a chance to double investors' money in a short period of time. Let's not mess around. Let's lock in these gains and sell the property. The pricing was getting out of control, and I know people that waited too long to sell, and now that it's probably down to 1.5 equity multiple for investors, and now they've held it for 5 years versus the 2 years where we just exited. So we wanted to lock in the gain, and when we saw the opportunity, luckily we executed on our business plan, so we were in great position, and that's really important. Like jumping in to your business plan right away and not dilly dallying, so that you could take advantage of those times when the market conditions are fantastic, or if market conditions are not favorable, you're way ahead of the game, which we've had to do on some of our properties that we bought in 2022. When you've had kind of negative rent growth and higher expenses, but we got so far ahead of it, we were able to sustain that and then ride through the tougher times.
Excellent. I know that we're running short on time. You've been generous with it, Gary. I do want to give you a chance to highlight how our listeners get in touch with you, and also highlight Break of Day Capital's current offerings, if there are any, and how they can get on your distribution list.
Yeah, appreciate it. Breakofdaycapital.com. You could get all of our social media links. You could see the deals that we have there. You could sign up for our newsletter and get these offerings, because we do have a fund, the multifamily impact fund right now. We are closing on our third deal in that fund in February, and we have an impact. We have an income fund as well, so you can see all that stuff on our website, and certainly book a call if you have a question, and get all the information that you need.
Gary, you've been so generous with your time. I'll look forward to chatting with you for a bit in the green room. Thanks so much for coming on the show again.
Thank you, Matt. Really enjoyed it.